Good evening, everyone. So happy to meet you all virtually. Again, my name is Ingrid Merriweather, and our firm is Merriweather and Williams, as Bonnie introduced us. And my goal here this evening is to spend about an hour or so, plus or minus, sharing with all of you kind of a fundamental understanding of bonding and insurance. And just by way of background, as Bonnie said, we are a licensed property and casualty brokerage firm. We too are small business, minority, and woman-owned. So I check all three of those boxes, and I tell everyone I'm not going for the disabled veteran one, though. And we've been in business for 23 years, and we are mostly known for the programs that we administer for public agencies in California that are designed to remove the barriers of bonding and insurance and some other technical subject matters that will lead to more successful participation of small and minority local contractors. And so with that, I'll get into the slide presentation and want to encourage you to ask questions as we go. This is kind of a technical subject matter, so I would hate for you to try to hold your questions after we've moved on from one subject to the next. So I understand I'm gonna get some support in monitoring the Q&A and the chat. So someone can alert me if you ask a question, and we'll take it right then and there. I'd like this to be as interactive as possible. And if you have a question, chances are my response to you will add to the overall understanding for everyone. So I want to encourage you not to be shy. And Ram, if you can advance the slide for me. Okay, so the first thing is to really distinguish the difference between bonding or surety and insurance. And I also want to make sure that, because this can get kind of confusing because you keep hearing the word about bond and bond program. And when, as respects the district project, bond refers to kind of the financial instrument used to finance the capital project. In this context, when we're talking about bonds, we're talking about bonds for contractors that are oftentimes required for them to participate on public projects. So I don't want you to get those two confused. But another term for bonds is surety. So you'll hear me use bonding and surety kind of synonymously because they mean the same. And so to first get an understanding of what's different about them, because they oftentimes just kind of get lumped together and it can get really confusing. As to what represents a bond and what is insurance. And they really are apples and oranges. They really don't compare, except for the fact that they both come from the same industry, from the insurance industry, financial services industry. Other than that, they're very different. One way to tell the difference is when you think of insurance companies, when they write insurance policies, they expect to have losses. That's kind of written into the process. They have actuaries who can actually do forecasting to determine, how much they're going to pay out in claims and losses based on statistical, historical data. And they know that they're going to have losses really on a daily basis. But their objective is to basically take in more in premium dollars than they pay out in claims and expenses, and that's essentially how they make a profit. But quite to the contrary, bonding or surety companies, they're very different. They don't expect to have losses. So they're structured completely different, and how you go about qualifying for surety is very different than insurance. Insurance, essentially, it's available to you. You can generally get the coverages you need. You can get the limits that you need. There's not really a qualifying process. It's just a matter of, can you afford the premium? Whereas surety bonds, they're really more like bank credit. You have to qualify for surety bonds, and I'll explain more in detail as we go through the process. Next slide, please. So we'll start, this is divided into two sections. So we'll talk about bonding first, and then we'll move in and talk about insurance. So why do you need bonds? Well, first off, if you're going to bid directly on any public works project with any public entity, a bond is legally required. Public agencies have to secure bonds from contractors who are bidding on work with them on a direct basis. And so many of you, certainly on the Peralta project, will more than likely be subcontractors and not prime contractors, but there may be other venues where you might bid as a prime for, maybe smaller projects. So various public agencies, Alameda County, for sure the city and county of San Francisco, offer contract opportunities, under $3 million. And in those cases, you can bid directly as a prime. But in those instances, you would be required to provide a bond. As a subcontractor, you may also be required to provide a bond if it's deemed a requirement at the discretion of the prime contractor or the hiring contractor, the contractor for whom you would be subcontracting out. So that is really the discretion of individual prime contractors, what their policy is in regards to whether or not they require bonds of their subs. Oftentimes they'll at least want to know, could you provide a bond? Essentially, are you bondable? In some cases, prime contractors will require bonds over a certain dollar amount of a subcontract, or they may require it where it's a new subcontract relationship, or in some cases, they may require it in every instance. I will say that in the new COVID environment that we all exist in, it's becoming more common for prime contractors to want their subs to bond, because as you'll learn a little further on, a bond is essentially a guarantee of performance of a subcontractor. And so there are obviously greater concerns about the financial stability of all businesses, but small contractors in particular. And bonding is a way a prime contractor can mitigate the risk of a subcontractor failing to complete their contract. So in a COVID environment, we're actually seeing an increased scenarios where bonds are required of sub. The other value of bonding, though, is that it really brings another relationship to assist in the development of your firm. Once you have a relationship with a broker, with the bonding company, and you've got bonding capacity established, the bonding company is a great source to really help you vet a direction of best suited opportunities for you to grow your business and really what to avoid, because they have a lot of knowledge and understanding about construction, what goes wrong for contractors, how contractors, grow too quickly, the kinds of things that occur that cause contractor failures. So that knowledge is of great benefit to your business. Next slide, please.
Ingrid, we have a question.
Okay.
The question is, so as a subcontractor, do we need to prove we are bondable, or is this something we need to take on ourselves? And that was from Luis. Okay,
Luis, so what you're going to hear me say is that it is to your advantage to establish bonding capacity long before whether or not you're going to know if you actually need it. Because by having it up front, whether you need it or not, you're in a position to say, well, I can bond a project up to a certain dollar amount. So that's an enormous statement of credibility about your company, because it means you've been vetted by a third party. So you never know what circumstances will impose a bond upon you, depending on which prime you might be looking to work with, what their policy requirements are. So securing bonding capacity, or a bond line of credit is another way we refer to it, is of tremendous value to your business, because it allows you to distinguish yourself, that you can bond a project. And sometimes Just being able to demonstrate that you can bond is sufficient for the prime to engage you as a subcontractor, and they may not actually require you post the bond on that project. But again, they know that because you can show evidence that you can bond, they know that you have gone through the vetting process by a bonding company. And so it's, it's kind of analogous to getting a pre-approval when you look to make an offer on a house, that you can demonstrate you can already qualify for the mortgage. Think of it in that way. It is of similar benefit to you. So what is a bond? A bond is really a three-party agreement that guarantees a contract or agreement. And so essentially the three parties to the agreement are the bonding company, you, who are considered the principal, the party being bonded, and then the person to who the bond obligation is due. So let's use the Peralta project and what will be prime contractors on this project as an example. Then the three parties would be you, the prime contractor, and the bonding company. Next slide. So again, the three-party agreement, a bond is really designed to protect someone else. Even though the bond is secured by you, the small contractor, the purpose of it is to protect another party. So more than likely, the purpose of it is going to be to protect a prime contractor whom is hiring you as a subcontractor to perform work. And again, just bear in mind, a bond is not something you can just go out and buy if you can afford it. It's something that you have to qualify for, which is more like credit. Next slide. So we actually already talked about the three parties to the agreement, so I don't even have to go over this one again. Next slide. Okay, so we're going to focus on contract bonds. Just understand the world of surety and the world of bonds includes a whole host of different types of bonds for different purposes. And a bond is really, for the most part, a form of financial guarantee by a bonding company. But in the context of construction and contractors, we're really talking about contract bonds. Now, all of you who are licensed contractors, you are required to have a license bond on file with the state of California. That's a requirement associated with your contractor's license. And I believe the dollar value of that bond is $15,000. And so we're not really talking about a license bond. I would expect all of you would already have that in place. In this context, we're talking about bonds that are required in conjunction with you being awarded a contract. So those are kind of divided into different types of bonds. First, there's a bid bond. This is in instances where you are bidding directly to a public agency and you have to provide a bid bond with your bid. And it essentially guarantees to that agency that if you are the successful low bidder, that you will complete the process and execute an agreement, essentially go forward based on your bid price to execute an agreement with that agency. Because if you fail to execute the agreement, let's just say you submit a bid and you later decide you don't want to go forward with a contract. Maybe you realize that you left a cost item out of the bid and you would essentially lose money, so you don't want to go forward. Well, that ends up having a consequence to that agency because they've gone through the entire bidding process, they've determined you're the successful low bidder, and then essentially you don't want to go forward. That means they'll likely have to go back out to bid, and more than likely they're going to pay more to another contractor. So a bid bond gives them some certainty if that were to occur. They can file a claim against the bid bond. The bid bond is usually for 10% of the bid amount, and that way that the agency can recoup some of their cost that are a result of you not following through and executing the contract. So you're only going to see a bid bond requirement for the most part, when you bid directly on a public agency opportunity or bid, prime contractors usually don't require bid bonds. Now, what might be required of you as a subcontractor from a prime is a performance and payment bond. And these two usually always come together. Usually both are going to be required. A performance bond guarantees completion of the contract. You know, you can actually visualize a contract document or agreement and a bond just wrapping around it, because whatever is in the contract that you have agreed to is essentially now the obligation or the guarantee of the bonding company that you will perform in accordance to what was in the contract. They are guaranteeing your performance. If you fail to perform under the contract and you are defaulted essentially for your failure to perform under the terms of the contract, then the obligation of the bonding company is they have to step in your place and ensure completion of the contract. So they bring in a replacement contractor, they have to perform the balance of the scope of work. That may even include redoing some work that was already done, and they are financially obligated up to the penal sum of the bond, which is essentially going to be the same as your contract value. So that's the obligation that the bonding company is taking on when they agree to provide you a bond, is they are essentially guaranteeing your performance of the contract or having to step in themselves and perform the contract if you fail to do so. And then the payment bond is a guarantee that you will pay your laborers, material suppliers, and subcontractors who are due a portion of your progress payments. Failure to pay those parties puts them in a position to file a lien or a stop notice. And a payment bond essentially is a guarantee that those parties are paid. If you fail to pay them and they prove that they provided goods or services for which they were not paid, then the bonding company steps in and pays that obligation on your behalf. And it's very formal and very structured in that the bonding company has a very prescriptive period of time that they have to make that payment good. So that's those two, as I said, come together, the performance and payment bond. And then a maintenance or warranty bond is essentially just the bond portion that remains after the work is completed that guarantees against any defect or workmanship. And it's usually a very short period of time, generally 90 to 120 days after completion of the work. Next slide. So what's important for you to know? First, before you bid, make sure you review the specifications and first understand, are any bonds going to be required of you? We've seen different practices by prime contractors. What they should do in all instances is make it very clear in the bid specifications if a bond is going to be required. It's not the kind of thing that you want to find out when you're ready to execute and sign off on the contract and they, ask you, well, where's the bond? So make sure you know whether or not a bond is going to be required. Make sure you can qualify for the bond before you begin the estimating process. I can't tell you how many times we've gotten late night phone calls from contractors who have a bid they have to submit the next day and they call us up trying to get a bond. It doesn't work that way. You have to qualify for a bond. It's a process. A submission has to be put together and go to the bonding company who has to review it. So it's not something that you want to wait and do at the last minute. And it's not something that you should put off determining whether or not you can qualify for the bond, because you don't want to learn that you cannot qualify for the bond after you've gone through, the bidding and estimating process, which is time consuming and costly. So here again, as I mentioned before, it's to your advantage to get your bonding capacity established far in advance of whether or not you're actually going to need it. Because once it's in place, and you know the dollar value of your bonding capacity, let's say it's $500,000, then you already have a sense that those are the size projects that you need to target, projects under $500,000, knowing that if a bond is required of you, you would have the established capacity to support that. And then like any bid documents that are required, you want to make sure that bonds that are submitted are properly signed and executed. This is really a task of your broker to make sure that this is done, but just something to be mindful of. Next slide. So you secure bonds through a bond producer or insurance agent or broker. You know, not all insurance agencies do bonding. There are a few brokers that only do bonding and don't do insurance, but more often than not, you'll find an insurance brokerage firm that also does bonding. But that's essentially where you're going to secure assistance in establishing a bonding capacity. It's important when you're looking for a bond agent or broker that they have the appropriate bonding company relationships. What's important is that they have a number of bonding carriers that they work with or markets, and that they work with markets who write small contractors. So the same bonding company that bonds Turner Construction, for example, is not likely going to be the same bonding company to bond any of you, because they don't typically work with small contractors. You essentially would be wasting your time. So it's really important that the broker or the agent that you're working with represents other small contractors, because then they're going to have a good portfolio of bond companies who write for small contractors. And also, just like with your insurance carriers, you want to make sure that you have a financially strong bonding company and that they would meet the rating requirements that would be imposed upon you. That just basically gives certainty about their financial stability, so that if there were a loss, you know, everybody wants to know they're going to be around to pay the claim. And then the cost of bonds range from 0.5% up to 4%. 4% is really high. And 0.5%, that's the kind of rate that, again, a Turner Construction pays. More likely, the range for most small contractors is between 2 and 2.5% of the bond amount. And remember, the bond amount is going to be the contract amount. So it's pretty easy for you to estimate. Once you've got your bonding capacity established, you'll be able to easily discern what the cost of a bond would be on any particular contract. Next slide. And then, of course, just like your insurance costs, you're going to include the cost of your bond premium in your bid, so that it's covered as part of the contract value. And that's where essentially you get funded for the premium to pay the bond premium. So now that you kind of have a sense of what a bond does, and again, a bond guarantees the performance of your contract, because your failure to complete the contract obligates the bonding company to hire a replacement contractor and come in and complete the contract up to the penal sum value of the bond. So that's what the bonding company is committing to doing. And they're also committing to paying essentially your obligations if you fail to do so under the contract. So with that understanding, you have a better sense of what a bonding company would then be looking for, what they would be focused on in terms of who they're willing to provide bonding capacity to. And we commonly call it the 4 C's. They're focused on character, essentially a sense of whether or not you're someone who meets your obligations. They're focused on capacity. Essentially, if the work that you're looking to perform, where you're seeking bonding support, is in your core discipline, and is it of a size that you have experience. So if you If you're a painting contractor and the largest project you've done is $250,000 and you want to bid on a $500,000 excavation contract, then there would be a big question about your capacity to perform a different scope of work at twice the value of the largest project you've done in the past. So that's what they're referring to in terms of capacity. They're also looking at capital. Bonding companies understand that as a contractor, particularly one on a public project, that you essentially have to finance your work until you process and receive progress payment reimbursements. And at minimum, that's a time frame of 60 days, right? You're going to perform work for 30 days. You're going to submit a payment application or a progress payment request, and you're going to take more than likely another 30 days to get paid. And that's kind of in a good scenario. We all know that there are oftentimes that it doesn't even quite happen that quickly. So a bonding company wants to know, well, what capital, what financial resources do you have to cover that cost? Because they know you're going to be waiting a couple of months essentially to get reimbursed. And then the fourth one is really the conditions of the times. During 2008, during the recession, there were more contractor failures in a 5-year period than there had been in a 25-year period. And as you might imagine, the concern is the same in our current times with COVID and the recession and what's projected in terms of the recession. These are particular times where bonding companies will be factoring this in and have an awareness that businesses are having financial impacts as a result of COVID, and that's going to be factored in. Next slide. Here's the other thing that's really important for you to understand about a bond that's very different than insurance. So, everyone has enough familiarity with insurance. Take a auto insurance policy and you have an accident and it's covered by the insurance company and they pay the claim. With the exception of your deductible, they don't come back to you to get their money back. Whatever the claim payment was, that's on the insurance company. Well, bonding is completely the opposite of that. In bonding, you're going to sign a general indemnity agreement, which means if the bonding company pays a claim as a result of a performance default by you or a payment default, then the general indemnity says you will make them whole. So that's why bonds are very different. That's why you have to qualify for bonds, because bonding companies will seek to recover any claimed, paid, or losses they incur on your behalf. And that's essentially what a general indemnity agreement establishes, that they then can come and, attach whatever assets they can get a hold of as a remedy to make themselves whole for payments that they've paid out on your behalf. And they're going to expect the parties to that indemnity agreement will be you, it'll be your spouse, and it will be any owner who has 10% or more ownership of the company. So basically, it's everyone who has a significant role or ownership in the business, as well as spouses, have to sign the indemnity agreement, because it is the assets of all of those parties that could be subject to liquidation in the event there's a default on the bond. And this is both the business assets as well as your personal assets. Next slide.
Ingrid, we have another question.
Oh, okay. Go ahead.
Okay. So are subcontractors required to provide maintenance and warranty bonds for 1 year if the GC is required to give a 1-year warranty?
Not necessarily. That isn't always passed through to a subcontractor. A lot of times it depends on the work. So, for example, I'll use a painter as an example. You generally don't need a warranty period for painting work that's done. have, the touch-up paint that's has to be done after you complete the work, but generally a warranty period isn't required. So it varies, but that's generally built into the payment and performance bond. It's not a separate bond that has to be secured. And as I said, it's usually only 90 to 120 days. And then, this is where there's a little crossover between bonds and insurance, because insurance covers construction defects, for example. So there's a little kind of crossover here, and that's the other reason why the warranty period is usually 90 to 120 days and no more, because you still have general liability insurance that would respond if there is a construction defect issue that's discovered, and there really isn't a time limit associated with that. Okay, next slide. Okay, so giving you a sense of what the underwriting process is like, and it's really very similar to pre-qualifying with prime contractors. You'll notice a lot of commonality between what a prime contractor who puts you through their pre-qualification process, what that looks like, what they focus on is very similar to bond underwriting. So they're going to take an in-depth look at your finances, both company and personal finances. As I said before, one of the things they're trying to determine, well, they're trying to determine two things. Do you have the financial wherewithal to fund the project, right? Because you have to pay for project expenses before you receive progress payments. And they're also determining what assets are there, because again, they want to know if they had a default and they had to come and recover from a default or a loss, what assets are there that they would be able to attach. So they're looking at both the company financials as well as personal financials. They want to know, do you have the experience for the required obligation? Again, my example of, if you're a painting contractor, but you want to do excavation. In general, do you have the ability to meet the obligations under the contract? Do you have the resources? And then what's the quality of your presentation, your bonding application that you submit? One statement about your business is the quality of your paperwork, your financials, what condition they're in, not as, partly, of course, what they say in terms of your financial position, but presentation matters because it's really a statement about how you take care of the business. So all of this you can appreciate is the same thing you would want to know if you were providing some type of performance or financial guarantee for someone else, particularly someone you don't know and are not ever going to meet. And so it helps you to understand, okay, this is a lot and this is challenging, but you can appreciate that given the risk they're taking when they provide you a bond, that this is actually very reasonable for them to want to underwrite in these areas. Next slide. And really we can move past this. The only thing I'll say, because I already talked about, finding the right broker, but I do want to be clear that you want to make sure that the relationship, that the broker that you choose is someone that you're comfortable with, because they're going to be looking under the hood. They're going to see credit reports, they're seeing financials, they're seeing, any kind of collection items or anything of that nature. They're going to bear witness to all of that. So you want to make sure that you feel comfortable with them, because you're going to be exposed in the financial sense with all of your information. And that's critically necessary, because your broker really is going to be the one who's going to take you out to the surety marketplace and try to secure bonding. So you're not trying to hide things from them. You need to be transparent and forthcoming with all the information, because there are things that can be explained or other strategies to mitigate risk. that, you know, they're in a position to help you with in presenting you to the bonding company. But again, you have to be comfortable with them. This is not a party that you can shuck and jive with and not share your information, because it will come out in the process, and then that puts your credibility in question if you haven't been forthright about it. So feel comfortable with your broker. Best way to find a broker is a referral from another small contractor who's happy with their bond broker. Next slide. So I've really mostly spoken already about the kind of the necessity of bonding. And again, even though it's really being secured as a requirement to protect another party, one of the ways that the bond benefits you is that if someone does allege that you defaulted under a contract, the bonding company doesn't just show up with their checkbook. They're going to do an investigation first. They don't want to pay a bogus claim or a claim that they think is not accurate. So they will defend you in the sense that they don't agree that you failed to perform or meet an obligation. And so through their investigation, you essentially get extended some protection if they deem that a bond claim wasn't warranted. So that's actually a benefit to you. In some cases, they'll review contracts for you. Now, not the same as an attorney would do, but bonding companies have innate knowledge in, you know, language that's in contracts that can be onerous to you. So I'll give you an example. It's not uncommon for a prime contractor to pass through the same liquidated damages that they have under their contract to your subcontract, even though their liquidated damages are in conjunction with the entire project. It's not really appropriate that they pass along that same level of liquidated damages to a subcontractor that's doing, you know, $1 million drywall contract. So a bonding company will identify those kinds of onerous conditions in a contract that aren't appropriate. And usually that's a basis for you to negotiate a change, which ultimately protects you. But really one of the main reasons that you want to get your company bonded is, again, that statement of credibility, that distinguishment that says you have been vetted and as a result have bonding capacity of a certain dollar amount. Next slide. If you are ever declined for a bond, ask the bonding company, again, through the broker, for a letter stating why. They have to share with you exactly why they declined you, and then work on improving that situation. Next slide. Very important, you want to maintain your bonding relationship. So, you know, bonding is not like a commodity. You're not going to shop it around every year and see if somebody will, you know, shave off 0.1% on your rate. The rates are going to be pretty standard amongst different bonding companies. This is more about a relationship. And the long-term nature of the relationship is to your benefit, because you build over time through demonstration of successfully completed work with that bonding company that gives them an increased comfort level that they will increase your bonding capacity over time, enabling you to take on larger projects. That doesn't occur if you're kind of bouncing around from one bonding company to the next. That's never going to be to your benefit. One of the other things that's important, if you do secure a bond on a project that you're working on and problems arise on that project, you don't want to hide the problems. You don't want to keep that from your broker and the bonding company. You would be surprised at what they can bring to the table in terms of assisting you in resolving the issues that are occurring on the project, because ultimately they don't want to pay a claim. So, and they have a tremendous amount of knowledge because they are in these scenarios on a daily basis. So they are very creative at coming up with proposed solutions to address problems to avoid a claim that they don't want to pay and you don't want to have to make good on. So it's really important to maintain open communications, particularly on difficult projects, because the bonding company can actually be instrumental in stepping in and helping you get through a particular problem or issue. Next slide. So before I mention some of the bonding programs that we administer, one kind of fast track way to qualify for bonds, there are several bonding companies that work with small contractors have what are called quick qualifier programs. And essentially it's a one-page application. They pull a credit report, and I think it's 650. If your FICO score is 650 or better, they will extend bonding capacity to you up to, I think the largest I've seen under a quick qualifier program is $350,000. So for those of you who don't have bonding in place currently, that's the best way to start. Go to a broker, use the quick qualifier program. You can get $300,000 or $350,000 of bonding capacity established pretty easily, and then you can build upon that over time. And if you are a small contractor within the city and county of San Francisco or Alameda County, and then we have 2 programs in Los Angeles, there are resources that are extended to you as small contractors when you are bidding projects with these entities. So with the city and county of San Francisco or with Alameda County, not just in Alameda County, but with Alameda County as an agency. And these programs that we administer provide collateral support for you to help you qualify for the bond. In San Francisco, well, San Francisco and Alameda County, they'll put up as much as $750,000 of collateral, or 40% of the bond amount, whichever is less, to actually help you qualify for a bond for a project with one of those agencies. And then you're provided a tremendous amount of technical assistance and contract support through completion of the contract. So these agencies have invested in these programs that are designed to get you over the hurdle and the barrier of bonding, and really give you a way to contract with them and secure the required bonding. We've done almost $1 billion of bonds through these programs over the last 2 decades. So they can be very helpful in helping you establish and build your bonding capacity. But again, I just want to underscore, it's to do business with those particular agencies. Next slide. And I think we're going to be switching up now. Okay, so we're going to switch gears, but before we move into a new subject matter, if there's any other questions that folks want to ask about bonding, otherwise we'll go ahead and just make the transition into the insurance slide. If you can advance the slide. Oh, you have a question?
No other questions.
Okay, all right, well, I'll keep it moving then. I know it's getting dark outside my window, so I know everybody's stomach is starting to growl and you're thinking about dinner time. Okay, so we're going to switch gears real quick. I'll try to move a little faster through the insurance portion. And really, to start, this just focuses on giving you kind of a practical understanding. I mean, you all know that insurance can be complicated and a lot of legalese and insurance policies, and there's so many different types of coverages, but this is really just to keep it at a practical level and designed specifically for contractors. So we're going to talk about the coverages that are usually required of you as contractors, kind of how you should think about them, and kind of what they cover and how they're underwritten. But one thing I always like to share with businesses is guidance that you don't want to develop your insurance program solely on the basis of what others require of you. Because when others are requiring insurance of you as a subcontractor, as a tenant, whatever the case may be, those insurance requirements are designed to protect their interests, not your interests. So you don't want to build your insurance program on just the basis of what you've had to put in place to meet some requirements. You want to build your insurance program to protect your business. And I can assure you that when you approach it that way, 9 times out of 10, you'll automatically meet the insurance requirements imposed by others. But that's a better way to develop your insurance program. Protect your self-interest, then worry about meeting the requirements of others. So insurance, we kind of break them down into 3 kind of big bucket categories that we're going to talk about. First party coverages, essentially that's property insurance. That's insuring your stuff. So your office furniture and fixtures, of course, if you own a building, it's insuring the building. And then we'll talk a little bit for contractors in particular, it's really important that you insure your tools and equipment separately than you would your business personal property, for example, because your tools and equipment don't stay in one place. Your desk and your office furnishings, they are permanently located at your business location or your home office location, and that's where they are insured when they're at that location. But your tools and equipment don't stay at that location. They're in a trailer site, they're in a laydown area, they're in your truck. So you want to insure tools and equipment separately, and we'll talk about the kind of coverage you get for that. Third-party coverages, this is really where you get into the area of insurance that's imposed upon you by others, because it essentially protects you and other parties in the event someone brings an action against you, alleging you were negligent in some way. And that's kind of described as third-party coverages. So we'll talk about those a little bit, and we'll talk about workers' compensation. Next slide. Thank you. So these are the specific coverages that your insurance portfolio should be made up of, the first 4 of these. So commercial general liability, we'll talk about that, workers' compensation, commercial auto liability, and a contractor's equipment floater. So that's the coverage we talked about for your tools and equipment that's mobile. We'll talk about professional liability really briefly. That's mostly for, in the construction arena, that's mostly for architects, engineers, construction managers, program managers. So we won't spend a lot of time on that. We'll talk about builder's risk, very important for you to understand that, and a little bit about OSIPs and CSIPs. Next slide. Okay, commercial general liability. So this is essentially liability insurance for actions brought against you by third parties, which is going to, for the most part, be the public, the general public, not actions brought by your employees, not actions brought by, well, it could be brought by the clients for a construction defect, but brought against you for allegations that your negligence caused bodily injury or property damage. So this is very specific that the loss that has occurred that would trigger the policy is someone alleging that you were negligent in the scope of your operations or performing your work, and that your negligence led to bodily injury of someone or damaging someone's property. So important coverage for you to have on your own to protect your business, because as we all understand, anyone can sue you, right? Doesn't have to be legitimate, but they can sue you alleging you were negligent. And this provides you with defense in the event that were to occur. So this is just an important, basic general liability policy that all businesses should have in place. This is also something that's always going to be required of you when you enter into a contract. It's going to be required if you have a lease in a building. The landlord's going to require that you have this. If you're a subcontractor to a prime, you're going to have this. If you're performing work directly for an owner of a project, you're going to have this. A bank may require that you have this for loan or financing. So this is kind of a pretty universal coverage that you would be expected to have in place. Generally, it's going to be, your requirements are going to be that you maintain a minimum of $1 million per occurrence and a $2 million aggregate. So that means the per occurrence means how much the insurance company would pay for a single occurrence. And the word occurrence is really important to understand that that means an event. It doesn't mean the number of people who were affected by that event. It's the event. So let's use an example that you're a contractor who was putting up 3 stories of scaffolding for a building under construction. And the scaffolding wasn't properly installed, wasn't properly attached to the building. The scaffolding pulled away, and some of it started falling on just members of the general public walking by. And let's say 2 or 3 people were injured by falling debris. Well, that's 1 occurrence. That's not 3 occurrences because it was 3 people. So when you think about the limit, $1 million, it has to cover all the people who were injured in that example, right? Because that was 1 single occurrence. So that's important for you to understand when you think about, well, how much liability limits should I buy? Recognize that you can have a catastrophic single incident that can cause injury to multiple people, but would still only be deemed 1 occurrence. And then the aggregate limit, that $2 million, that's essentially the maximum limit of the policy during the policy period, which is going to be 12 months. So the carrier is committing to pay up to $1 million for a single occurrence and up to $2 million during the policy period, okay? You're always going to be asked to name an owner, a prime contractor, a landlord as additional insured in your general liability policy. Common requirement because you have a relationship with those parties. Again, let's use the Build Peralta project. You're a subcontractor to, let's just say, Turner Construction. They seem to be who I'm picking on tonight. And they're requiring you to add them as an additional insured under your liability policy because you've subcontracted to perform work on their behalf. If something goes wrong and someone alleges there was bodily injury or property damage, and they were also named in the allegation, which would more than likely happen, they want you to be responsible. They want your insurance policy to step up and provide them with the defense and pay any claims or settlements. So that's what additional insured establishes. It extends your policy to some other party and essentially protects them the same as it would you under the policy. So this is commonplace. Insurance carriers do it, 1 million times a day, as long as the party asking to be added as an additional insured is appropriate, meaning they have an insurable interest, their relationship with you, like a landlord tenant, then this isn't a problem. It occurs all the time. The components of a general liability policy, as I said, first, it covers bodily injury. So someone alleges they have been hurt as a result of your negligence. That's the design of this policy. It will respond. And bodily injury is broader than just, the injury of that person. It would extend to emotional injury like distress, emotional distress. It would even extend to, say, a spouse of an injured party who's now impacted because their wife or their husband has been injured and they now can't perform the duties that they would in the family or in the household. So all of that resulting from someone being, in this case, seriously injured, all of that would be covered as a bodily injury. And then, of course, property damage. Very straightforward. Someone alleges you were negligent, and as a result, their property was damaged. A general liability includes product liability. Now, for most of you as contractors, you don't make a product, So it doesn't apply to you. But if, if someone makes a product, for those of you who remember, it was many years ago, Odwalla was selling unpasteurized apple juice, and a lot of people got sick and some people died. That's product liability. But completed operations, that is applicable to all of you as contractors. Completed operations essentially is covering work that you have already performed and completed, but are no longer under contract for. So you're hired as a drywall installer, you install, 4 stories of drywall, the work is complete, and you leave the project. That's now a completed operation, but it is still covered because it could be a year, 2 years, months later that the drywall starts coming apart for some reason, wasn't installed properly, and now there's a claim against you. That is still going to be covered by this general liability policy you had in force at the time you were performing the work. So another example to understand completed operations that, we all can relate to: you take your car to a mechanic, they work on your brakes, you leave the mechanic's lot, you get on the freeway, you go to put on your brakes, they don't work, and you crash into someone. That was a completed operation of the mechanic. The mechanic is still responsible. They were negligent in how they did the brake job. You would sue them under their general liability policy, even though you had already paid for the work and you had driven it off the lot. A general liability policy also includes personal and advertising injury. Personal injury is allegations of libel, slander, defamation of character. Doesn't happen that often, but essentially you don't want to go around telling lies about your competitor because they can sue you. But if they do, it's actually covered under your general liability policy. Advertising injury is essentially false advertising, not something that contractors usually have to worry about. And then the last part built into a general liability policy is called medical payments. It's usually a very small limit, $5,000 or $10,000. We kind of refer to it as no fault insurance because it essentially says if somebody comes on your premises and they trip and fall because there's bad housekeeping, extension cord, and they injure their wrist, essentially you tell them, go to the doctor, get that taken care of, send me the bill. You send it into the insurance carrier, they'll pay it in a hot minute. Because essentially if they can take care of small issues like that, folks are less likely to go get an attorney, and we'd be looking at a lot more money. Okay, next slide. Shonda, were you trying to get my attention for a question?
Yes, I was. So we
Okay.
have another question. Does this include insurance coverage for errors and omissions for architects? And that's from Fred.
Okay. And Fred, no. I haven't gotten to professional liability yet, so nothing I've covered thus far includes errors and omissions for architects or professional liability, but I'll be getting there in a second. Okay, so we talked about the general liability policy being $1 million limit, right, per occurrence. Well, the way that you increase that is you purchase what's called an umbrella or an excess liability policy. They mean the same thing. And that's how you increase that $1 million to $2 million per occurrence, or $3 million or $4 million, whatever the dollar amount that you want in terms of total liability limits and that you can afford. So oftentimes we're asked, well, how much liability limits should I have? And, the standard industry response is, how much can you afford? You can't always anticipate what's going to happen and what can be catastrophic. I can't tell you how many times, people have claims and losses and are regretful that they, kind of didn't buy as much limits as maybe they could have. So the best thing to do is, when you get your insurance quotes, is to always get a quote for higher limits than you have, so that at least you're making an informed decision about what you can afford to purchase, right? You're not just assuming that it's going to be too much, because I can assure you at the time a loss occurs, you're not worried about, you paid an extra $500 in premium for that extra $1 million of coverage. But if you didn't purchase it, the extra $500 in premium is minuscule compared to having an uncovered loss. And the thing about limits is the more you buy, the cheaper they get. The first $1 million of coverage, that's going to be your most expensive portion of your premium. Your second million might be 50% of the premium of your first million. And then your third layer of $1 million coverage is going to be even less. So the more you buy, the cheaper it gets. So that's why it's advantageous for you always to get a quote for higher limits and then purchase all that you can comfortably afford. General liability is underwritten on several kind of core components. First is your loss history. The best indication to an underwriter of the probability of you having claims or losses is what your history of having claims or losses has been. So you have to submit what are called loss runs. They're issued by your current insurance carrier that give information on what claims and losses you've had in the past. And they're usually looking back 3 to 5 years. So that's the first thing they're looking at. Then they're looking at your scope of work. All contractors don't have the same risk profile. A contractor doing painting is a much lower risk profile than a contractor doing roofing. So they'll look at your scope of work, and then they apply the rate that they've determined against your projected payroll or gross receipts. Different insurance carriers use different bases, and that's how they determine the premium that you pay. The thing to understand about how a general liability policy is written is that it's essentially written where it covers everything. It even reads that the insurance company has the duty to defend you and cover claims and losses. And then it says, except for what's excluded. So that's how the policy is designed. It covers everything except for what's excluded. So if you're not inclined to read your liability policy from beginning to end, which wouldn't surprise me, just read the exclusions. Read what's not covered, because if it's not identified as excluded, it's covered. So it's a lot easier for you to keep in mind, okay, my general liability policy doesn't cover any townhomes and condominium work that I might take on. That's something that you're going to remember. And you would know you either aren't going to take on that work, or you need to make sure the owner is putting something else in place to extend coverage. So best thing to do, read the exclusion section of your general liability policy and know what to avoid or what would not be covered if it occurred. Next slide. Okay, just a minute or two on workers' compensation. Most of you are pretty familiar with workers' comp. It's mandated by law in the state of California. It's got what's called statutory limits. Workers' comp covers an injured worker's medical payments and lost wages. That's what the statutory limits are. Covers an injured worker's medical expenses and lost wages. There is another section of workers' compensation that's called employer's liability, but this is rarely triggered, and it only happens when there has been deemed egregious negligence by the employer, that you essentially knowingly and willfully put an employee in a hazardous position. Workers' comp is underwritten first also on your losses, but it's even more formalized in workers' comp because they have a rating bureau, the Workers' Comp Rating Bureau, who gets statistical information on every employer in the state with the claims, premium, and loss history of each employer, and they develop a number that's called your EMR, your experience modification rating. And it's a number that's some deviation of 100. It's either more than 100 or less than 100. More than 100 means you don't have favorable losses and you're going to pay a surcharge in workers' comp premium. If it's under 100, it's the opposite. You have favorable losses and you're going to get a premium savings. So your EMR is something that you should know at the top of your head because it's a very important number. Not only does it have an impact on what your workers' comp rates are, some projects won't allow contractors whose EMR is deemed too high. I've seen projects where they don't let contractors who have an EMR above 100 on the projects. So it's something your broker can tell you what your EMR is. It gets recalculated every year. And what's important for you to understand, it's made up of 3 years of claims and losses. So it's really important that you practice, good safety on your projects. First of all, you don't want your workers getting injured. But second of all, when you have a workers' comp claim, it affects your EMR for a minimum of 3 years. So you're stuck with higher rates as a result of claims that occur. So that's the first consideration for workers' comp. Then they classify your employees. So, you as contractors, you might have some employees doing contract compliance work in the office. Well, that's a clerical class code. That's a low rate versus the worker who's doing underground excavation. So you divide your employees based on the scope of work that they perform, and then there's a rate attached to that scope based on the risk associated with that job description. And then the last basis of what you pay is the payroll by employee classification. So again, workers' comp is where safety is so critical. And you as contractors have to invest in having an excellent safety environment on your projects, because again, you don't want your workers getting injured, and the financial impact to you on your workers' comp can be quite substantial. Something currently that's occurring right now with respects to COVID. Right now, for the most part, you as contractors who have workers out in the field, if one of your employees contracts COVID, it's more than likely going to be presumed that they contracted it at work. If their employees are at home, if your employees are at home, I'm fortunate to be in this situation. All 30 of our staff are working from home. So if somebody unfortunately contracts COVID, it can't be at a work related because they were in their own home. But anyone whose employees who are away from home and they contract COVID, there's a presumption that it will be deemed they contracted it at work unless you can prove otherwise. And as you can imagine, that would be really difficult to prove. And therefore, it's covered under workers' compensation. The good thing that the state did was, even though it's covered, those employees are covered under workers' comp, it does not get factored into your EMR, your loss experience. So you're not dinged for an employee who contracts COVID, who, if they have a bad case of it, they could be in the hospital and you could have, hundreds of thousands of dollars of a claim if they're on a ventilator over an extended period of time. You don't have to worry they're being excluded from the EMR calculation, but their medical expenses and their lost wages are still going to be covered under your workers' compensation policy. You're just not going to have that detrimental effect to your rate as a result of those claims. So thing about workers' comp, if you have good experience and you have a low EMR, it's going to give you a competitive advantage because your pass-through insurance costs are going to be cheaper than someone who has bad experience, who's going to find it harder to compete with higher workers' comp rates. Next slide. Oh, commercial auto liability, I don't spend a lot of time because everybody's pretty much familiar with auto liability, but the one thing that's important, so a couple things. If you are using a personal auto on the regular in your business, you really should sell the auto to the business. You can sell it for $1 and cover it under a commercial auto liability policy. Most everybody knows that, you know, your insurance carrier for your private auto is not contemplating you're using that auto in a business. You know, commuting back and forth to work, that's fine, but that you're using an auto on a regular basis in a business, it should be on a commercial auto policy. When we talked before about the umbrella or excess liability policy as a way of getting more limits, if you purchase an umbrella and excess policy, you can also schedule your auto policy on that. So you would also be increasing your auto liability limits, which is something that, you know, you can have catastrophic claims in auto with auto usage. Obviously, we all understand that. And then the last thing that's important here is as a company, an employer, if you have employees who on occasion or regularly drive their own personal vehicles on company business, they go pick up supplies, they go to the post office, whatever the case may be, but they're using their own personal auto. If they have an accident while they're working on behalf of the company and they are deemed at fault, then that injured party can sue your business because the employee was conducting business on behalf of your company at the time the incident occurred. For you to have coverage for the business, if you're sued as a result of that at-fault employee causing bodily injury to someone, you need to have what's called non-owned auto as endorsed onto your commercial auto policy. It's called scheduled, non-owned, and hired. It means that you schedule the cars you own, but you also add cars you don't own, which is your employees driving for company business. And then the hired auto is if you rent a car. So this is an endorsement you should absolutely make sure is on your commercial auto policy. It's pretty inexpensive. And if you didn't have this covered and you had an employee drive their own car on business, had an accident, you got sued, you would not be covered if you don't have this endorsed onto your commercial auto policy. So very important. Next slide. Okay, I talked before, and I'll just reiterate the importance of segregating out your equipment and tools, because for property insurance purposes, they don't stay in one location. They wouldn't be covered if you just had them lumped in with your desk and your other office furniture, and yet they got vandalized or damaged or stolen when they were, you know, in your pickup truck and, you know, you were parked at Home Depot. So you want to put them on what's called an inland marine form. Which kind of sounds like an oxymoron, but essentially it means it's covered wherever they are. And so you have to separate the value of your contractor's equipment and tools. And we're not talking, you know, your hammers and your wrenches and your screwdrivers. We're talking, you know, the costly equipment and tools that contractors oftentimes have. And you want to insure them under it's either called a contractor's equipment floater in some cases or an inland marine policy. That way, you know, they are covered if something happens to them when they're, no matter where they are. Next slide. I see a couple of questions. Shonda, do we have a couple questions? Okay, well, we'll come back to it. Okay, someone was asking about professional liability. So again, I think this was someone maybe in the architect and engineering field, but it applies to folks doing construction management, program management. My profession, I have to have professional liability. Essentially, if you are providing consultation or services that you're a professional providing those things, you have to have a specialty license. And the client who is relying on your work to make decisions. So let's use the architect and engineer example. You're being hired to design a structure of some type, and you're supposed to be determining its constructability. You're supposed to be determining things like weight load. And if you make an error or omission in your work and that client goes to construct the structure and then learns there is a design flaw, it actually can't carry the weight of the roof, let's say, well, now that's really an error or omission caused by the architect. And the client would more than likely sue the architect because there has been a financial harm they've suffered, right? They're going to have a loss, a financial impact as a result that they can't go forward and construct that building, or they did and it has to be redone or whatever the outcome is. They've had a financial loss. So professional liability responds to claims of financial loss. And you can purchase professional liability for a specific project. Let's just say it's kind of a one-off situation, or you can purchase it as a practice policy where you're maintaining it all the time because this is the nature of your work. And what's really different about professional liability than general liability, couple of things. One is your legal defense is usually within the limit of the policy. General liability, your defense costs are not part of the limit of the policy. They're paid separately. They don't erode that $1 million per occurrence. But in professional liability, it's common for your defense costs to be within the limit of the policy. So if you have a $1 million professional liability policy, it's got to cover your legal defense as well as any claims or judgments against you. So that's different. That also means, you know, $1 million may not be enough because it's got to cover defense and claims, settlements, or judgments. The other thing about a professional liability policy that's different is that you essentially, if you let the policy lapse, if you let the policy expire, it expires retroactively. It's as if you never had it in the first place. So if you're an architect and you've been in business for 4 years, you've maintained professional liability that whole time in your 4 years, you've designed 30 buildings, and you just decide, I don't want to pay for this coverage anymore. I don't think I'm ever going to need it. And you just let it expire. Well, then you just lost the coverage that you had for the last 4 years. So if someone, you know, brings an action against you for a design you did a year ago, you have no coverage under this policy if you let the policy expire. So very different. That's not the case with general liability. As long as the policy was in force at the time the work was done, even if a claim was made 7 years later, it's still going to be covered under that general liability policy. Not so with professional liability. There is a way that if, for example, you're closing up shop, you're not, you know, you're retiring, you can purchase what's called an extended reporting period, where you pay a premium and essentially it gives you coverage for work you've already done, but it wouldn't give you coverage for new work. Okay, next slide.
And we have 2 questions, Ingrid.
Okay, go ahead.
Okay. From Fred, what if one uses a zip car for business trips? Do you need commercial policy?
Ooh, that's a good question. And what I would do is read the rental agreement with a zip car, because they should be very clear whether or not they are providing insurance. If you have hired auto on your own commercial auto policy, then it would be covered, but that's always liability only, meaning it wouldn't cover the zip car itself if you had an accident. It would cover the damage or bodily injury you caused to somebody else. So I would check whatever the contractor agreement is with Zipcar. I'm not familiar with them, but you know, then decide. Usually, you know, if they're not providing the insurance, they're offering it to you for a price. But if they're expecting you to have insurance, which would surprise me, I would think not, because some people use zip cars and they don't even have an auto. They don't own an auto, so they don't have insurance. So my guess is that that's covered by the zip car entity themselves, but I'd read the agreement first. You had another one, Shonda?
Yes.
Okay.
It's from Earl. Are the premiums higher for commercial car insurance versus personal insurance?
Actually, Earl, they're not. They're actually more competitive than personal auto insurance because, one, they're purchased for a business. You're not likely to have, your teenage son driving the business car. And, the uses in commercial use. So you actually get a premium break under a commercial auto policy, especially when you compare, you're going to buy at least $1 million of limit for a commercial auto policy, whereas a personal auto policy, you're likely buying much lower limits, but you're paying a higher premium rate. So it's always better to switch to a commercial auto policy. Okay. Builder's risk. So what's important about builder's risk coverage? Builder's risk coverage is property insurance for a building while it's under construction. So those of you in the Bay Area, Oakland in particular, you've seen we had a rash of arsons and fire destroying buildings, especially, housing units or apartment complexes that were under construction. I think there was one on the border of Emeryville and Oakland. It burned twice. I mean, it burned down the first time, they started building it the second time, and it got torched again. So as you know, this happens, whether it's from, electrical arcing or some type of welding that goes wrong, or some vandalism that occurs. But buildings under construction are very vulnerable to property damage or out and out just destruction. There was a building, probably some of you are familiar with, a number of years ago, a housing development project right next to the Oakland West BART station. And, halfway done, it got torched to the ground. I don't even think they ever came back and tried to rebuild it. So what's important for you to know when you're working on a project is that someone has put this coverage in place. More than likely, it's either going to be the owner or the prime contractor. But the reason why you care is because as a subcontractor working on the project, you have an exposure. So use an example that you're a carpenter and you are installing the cabinets in a 300 unit mixed use apartment complex. And you've installed, 50 cabinets and 50 units, and you have another 50 cabinets to be installed in the laydown area on the project site. And that's when the building burns and collapses. And you have not yet been paid for the cabinets that you installed or the ones waiting to be installed. You then have a claim against the builder's risk policy. And so it's important for you when any project you're working on is to find out, well, who's got the builder's risk policy for this project? And to be honest with you, you should actually get a certificate of insurance because you're covered, should be covered under that builder's risk policy. The named insured in the policy should read the prime contractor's name, probably the project owner, and language that says, and subcontractors of every tier, because the intent is the builder's risk policy should cover anyone, any contractor who suffers a loss for materials or work that was already done for which they have not been paid. So very important for you to find out who has the builder's risk and try to get a certificate of insurance. So you have some documentation that shows the policies in force, what the limit is, who the insurance carrier is, empower yourself to have that information if a loss occurs. Okay, next slide. And I think we're getting close to the end here. Okay. I think I pretty much covered this. We can go on to the next slide. Okay. So we're getting close to the end, and I just want to spend a minute to talk about OSIPs and CSIPs. So on larger projects, usually the threshold is $100 million or more. So the Build Peralta program will definitely have projects of that size, and it's possible that they will elect to either put in place an OSIP or a CSIP. An OSIP stands for an owner-controlled insurance program, and a CSIP stands for a contractor-controlled insurance program. They are essentially the same concept. The difference is that an OSIP, the owner puts it in place, and in a CSIP, a contractor puts it in place. Another term that's referred to as a wrap-up. It essentially means the same thing. So what these programs are, it's a project-specific insurance program that is put in place for a specific project or maybe even a number of projects. And it's designed to provide insurance for the owner, the prime contractor, and all subcontractors performing on-site work. And the reason why some of these get in place for large projects is there's usually cost savings. So let's say if the owner puts in place, doesn't matter, the owner or the contractor, they have the benefit of economies of scale. They can get better insurance rates insuring the entire $500 million project than paying the incremental insurance charge from every single contractor on the project. So that's one reason they do it. There's the potential of cost savings. Another reason, they like the idea of there being a single insurance program that they control in the event that there are claims and losses, having to identify the responsible contractor and go after them and go after their insurance carrier. And, it could be a complicated claim, and, one contractor is saying another contractor is responsible. So sometimes they don't want to deal with that. They want to control the insurance for the project, especially on larger projects. So that's kind of the reason why some of these are used on large projects. If any of you have worked on any of BART's capital construction program, BART does all their construction projects under an owner-controlled insurance program. So what's important for you to know is, first of all, if you see in bid specs or how a project's being advertised that they say there's an OSIP or a CSIP in place, the first thing you want to know, okay, well, what coverages are provided for on the project? Because they pick and choose what they're actually covering in the OSIP or CSIP. More often than not, it's going to include general liability. It's going to include builder's risks, and in some cases, it might even cover workers' compensation for your workers working on site on the project. BART, for example, includes workers' comp in their OSIP. Okay, so first of all, you want to find out, well, what coverage is being provided? Understand that even if an OSIP or a CSIP is in place, you're still going to be required to provide evidence that you have liability insurance and workers' compensation. Even if it doesn't apply to this project, you still have to demonstrate that you have it. And they do that for a couple of reasons. One, they don't want to have claims under the OSIP or CSIP unrelated to their project because you don't have insurance in place for another project. They don't want to find those claims somehow ending up on their project. So that's one reason. And then the other is the coverage under the OSIP or CSIP is just for on-site work. So if you were doing some type of metal fabrication off-site and then bringing it on-site, it's only going to cover on-site work. So you would have to show you have off-site coverage if the scope of your work happens to include something that's actually done off-site. It's important for you to read the bid specs and the contract closely, because you're going to bid this project differently than you would a project that did not have an OSIP or a CSIP on it. One, you're not going to include your insurance loading, and they'll give you directions on how to bid it. And I encourage you to get your broker to assist you with this part, because you generally have to calculate what would the insurance have cost had I provided it on this project. And your broker is probably in the best position to help you kind of calculate that and figure that out. And then it's important to follow the directions, because they may just tell you, we'll leave your general liability and workers' comp cost out of this bid. If you're not paying attention and you bid it the way you normally do, you're going to be higher than somebody else. So that's really important. Understand whether or not you might also be responsible for any deductibles. So it's not uncommon that when an OSIP or CSIP is put in place, they may still pass through a deductible to a contractor who's deemed responsible for causing the loss. So let's just say builder's risk coverage, and you're the welding contractor, and there's a fire that's deemed caused by the negligence of a person doing some welding work, and it's a $250,000 claim. They might make the contractor who was doing the welding responsible for some portion of the deductible. And the deductible in OSIPs or CSIPs for the owner or the prime contractor who put the program in place is a minimum of $250,000. Now, they wouldn't be passing that high of a deductible to you, but that's how high their deductible is. So that's where they get a lot of the cost savings, because having that high of a deductible means the insurance carrier isn't paying any claims until they exceed $250,000. So they get an enormous premium credit for doing that. But it also means how they're going to have more than likely a project-specific safety program on that project that they're going to expect you to be in full compliance with, because that's how they keep the insurance costs low, is to avoid or mitigate claims. But find out whether or not any deductibles are being passed through to you, because you want to take that into consideration when you bid. Next slide. I think we are at the end. Oh, nope, a little more on OSIPs.
Yeah, and Ingrid, I just want to do a time check. It's 7. It's a little after 7.
Okay, and I think we're about done. I'm trying to think if there's anything. Oh, one thing to note that I think is important off this slide is, if workers' comp is covered under the project insurance, even though they're covering workers' comp claims for your workers on that project, any claims or losses still get reported to the rating bureau as your claims and your losses. So they still get factored in to your EMR rate. So you don't escape that. And it's kind of a good thing, because they want to make sure you're still practicing safe practices to keep your workers safe, because you're still going to be hit with the claim or loss. Next slide, and because I think that's it. Just to be sure. Already talked about that. You can go to the next slide. Just know that if there is an OSIP or CSIP, there's going to be extra paperwork that you're going to have to complete depending on what coverage is in place, and just make sure you comply with all of that, because we've been involved on OSIPs where we have withheld retention or even progress payments from contractors who didn't submit their OSIP paperwork. And that's it, unless there's any last remaining questions, Shonda.
How long do we need to keep professional liability after a project is completed?
Very good question. So usually the contract will stipulate how long you have to maintain professional liability coverage for the specific to that project. So follow the language in the contract. But what I will say, and this is really applicable to whether it's professional liability or general liability, that you don't just because whatever the insurance requirements are imposed upon you, it doesn't change the fact that you have also agreed to indemnify or hold the owner harmless. So you, even if, let's say, for example, in a general liability policy, they require you to have $1 million per occurrence. If there is an incident that occurs and it's, 1.5 million, you're responsible for 1.5 million. Just because they only capped the insurance requirements at $1 million doesn't mean you're off the hook for the additional $500,000. So something else to keep in mind when you're deciding how much limits you're going to have is your indemnification and your hold harmless language supersedes what cap they put on the insurance requirements. And they do that because, if they asked you to have $5 million of insurance, well, that's going to be a lot more premium that you're going to pass through to them. So they cap the insurance requirements, but that doesn't cap your liability. Same thing with professional liability. Even if they say you have to maintain it, 2 years after completion or 3 years after completion, the indemnity agreement and the hold harmless language may extend beyond that. And so even if you let the insurance lapse, it doesn't mean that you're off the hook and aren't going to still be deemed responsible for some, error or omission that was made that, crops up as an issue 5 years later. So again, another reason why you don't want to let the insurance requirements that they stipulate be the total determinant factor in what you put in place, because you can find yourself lacking coverage that you need at the time that you need it.